The Fed's preferred inflation gauge just moved in the wrong direction. More on that coming up on Business Matters. Good afternoon, and thank you very much for joining me here today. I'm your host, Don Ma. To start off, as always, we're going to go to markets. U.S. stocks today closed higher. Let me tell you what contributed to that. It was actually buoyed by a rally in mega cap growth stocks following robust quarterly results from technology heavyweights, Alphabet and Microsoft. So investors was cheering Alphabet's first ever dividend. Meanwhile, Microsoft shares rose after its third quarter revenue and profit exceeded Wall Street expectations. So U.S. Commerce Department data as well showed monthly inflation rose in March and on an annual basis, while coming in line with estimates on a monthly basis. So this report that we got today offered, at least to some degree, a bit of relief to financial markets here. They were spooked previously by worries of stagflation, a day after data showed that inflation surging and economic growth, or GDP, slowing in the first quarter. Now, speaking of inflation, we have more on that right now. Inflation data earlier remaining stubbornly high here last month. This is according to fresh data released today. Inflation rose faster than expected last month. This is from the Federal Reserve's preferred inflation gauge. And what that is the personal consumption expenditures price index, rising to 2.7% for the year ending in March. Now, the rate was above economists' expectations and also landed above February's reading of 2.5%. So this sticky inflation rates is pushing investors to slash their expectations for interest rate cuts by the Federal Reserve. They're now anticipating simply just one cut this year, and this is way down from previous expectations for as many as 6 at the beginning of this year. More earnings today, and it's from oil giants Chevron and ExxonMobil announcing earnings today. Chevron reported an annual drop in first quarter earnings, and similar story with ExxonMobil. It also missed analyst estimates with a 28% year-on-year drop in the first quarter profits. So, the two are feeling the pinch of weak energy prices here. Fuels margins have cooled in the last year. At the same time, a glut of natural gas and a warmer than expected winter/natural gas prices, which also eating into their earnings. So for more on the outlook of oil price, I spoke to the chief oil analyst at Oil Price Information Service, Denton Cinquegrana. Here's what he told me. What are some of the movers right now in terms of oil going up or going down in either direction?
Yeah, well, right now there's a lot of tension going on in the Middle East. That's obviously playing a big role, probably adding a couple dollars of a quote-unquote risk premium. But at the same time, all things being equal, unless there's any sort of impact to production, you're probably not going to see runaway prices and some of the triple-digit type oil prices that some folks out there tend to talk about when you have these types of situations. Right now, it appears that Brent crude, which is largely considered the international benchmark, is probably in the upper 80s, just below 90, and it seems to be kind of comfortable there. It's been in that area for probably the better part of the past week. Meanwhile, West Texas Intermediate here in the United States is running in the kind of $83, $84 level. So these prices are actually, several dollars below where they peaked just a couple weeks ago.
And maybe you can comment on the demand situation here with oil, because yesterday we had the U.S. GDP number released, not too good, most would argue. So what is the dynamic here with that data and keeping in mind oil?
Yeah, no, it's interesting that GDP came in much lower than what a lot of economists had anticipated. We're also getting to the summer driving season. That should boost gasoline demand. But when you see GDP growth that low, the fact of the matter is, you have to be a little bit concerned about what the summer driving season may look like. Retail gasoline prices are very close to where they were last year. Today, the national average is $3.66 in the United States. That's about a penny higher than last year, so not a big difference versus where it was at 2023 at this time. One of the major differences is hotel rooms are $400 a night, and I think that may be a little bit of a deterrent from the summer road trips and heavy driving. But it's one thing to keep in mind that maybe the economy is slowing down and what kind of impact that has on gasoline demand, as really the official start to summer driving season is only about 5 weeks away.
So then let me ask you this, with all the factors combined here, GDP, tensions in the Middle East, and today we got the PCE number as well, so inflation remaining sticky. With all that in mind, what is your outlook for 2024 in terms of prices at the pump as well as oil?
Yeah, no, I think, I think we're pretty close to a first half of the year high. Retail gasoline prices got up to around 368 or so. That's probably, unless we see something happen over the next couple of days with the headlines, I think oil prices and as a result, retail gasoline prices are going to be pretty steady from here. We might get a little bit more upside, but probably not that much more. I think generally speaking for 2024, prices are going to probably end up averaging just a little bit less than last year, maybe about 4, 5, 10 cents lower. Also, one thing to keep in mind, it is an election year, and I think that may be one reason why investors may be staying away from oil, as the Biden administration may be a bit aggressive with using the strategic petroleum reserves to keep the price of gasoline, kind of at bay. But, I know there's been some people out there forecasting $4 a gallon this summertime. And honestly, I don't know where another 34, 35 cents in upside is going to come from, unless something happens with a rash of refinery issues, or we're getting close to it, but hurricane season, and there's a hurricane in the Gulf of Mexico that does potentially take out some Gulf Coast refining.
All right, well, Denton, great insight today. Thank you very much.
Thanks, my pleasure.
Now, besides big oil, two of the most watched big tech earnings today, Alphabet and Microsoft, ignited a rally in technology stocks with earnings that showed big AI investments were driving growth. So let's take a look here. Alphabet shares surged nearly 10% as we're looking at this right now, crossing $2 trillion in market value with a gain of tens of billions of dollars. Microsoft gains, let's take a look here, as well, up, and was set to add just under $100 billion in its market value. So, after pouring billions of dollars into the infrastructure needed to support AI applications, both Alphabet and Microsoft reported that their quarterly revenue growth was in fact outpacing expectations. Alphabet also announced its first ever quarterly cash dividend. The move is going to pay 20 cents per share to shareholders and is part of a $70 billion share buyback. All right, a different story though for Intel. Not so good. Its shares slumped almost 10% today, and this comes after a downbeat forecast. And the stock's fallen around 30% so far this year as Intel trails rivals in terms of chip companies such as NVIDIA in producing advanced AI chips and components. At the same time, Bernstein analysts said in a note that while they do believe Intel here is doing everything they can to try to repair things, it's clear to them, at least, the company is profoundly broken. And it's going to take years to see the fruits of their labor. Intel is planning a $100 billion spending spree across 4 states to build and expand factories. It's also unveiling a new AI chip earlier this year to keep up with competition, so let's keep an eye out here. Now let's talk about Tesla, the EV maker under the telescope. U.S. auto safety regulators said today they have opened an investigation into Tesla. And what this is about is it's over the company's recall of more than 2 million vehicles to fix a reported safety threat posed by its autopilot software. The NHTSA said that in December, in 2 years, it probed 1,000 crashes in which autopilot was engaged, and the probe found that the feature gave drivers a false sense of security. Tesla's December recall was to address that safety concern, but the agency says that the recall allows a driver to readily reverse the software update. So it's now opening the investigation to further evaluate whether that fix is enough. So there have been hints that Tesla may be taking a page out of the playbook of Tesla's old school Detroit rivals. And what I mean here is it's within the context of its newly announced affordable cars. You may have heard about that. NTD's Sean Marshall explains.
Elon Musk's new plan to churn out new affordable vehicles falls in line with traditional Detroit-style auto manufacturing. That's how some Tesla investors and analysts see it. Here's how Tesla plans to make these affordable cars.
As you mentioned, we're updating our future vehicle lineup to accelerate the launch of our low-cost vehicles in a more CapEx efficient way. That's our mission, to get the most affordable cars to customers as fast as possible. These new vehicles we built on our existing lines and open capacity, and that's a major shift to utilize all our capacity.
The shift toward incremental improvement is mirroring a common strategy of Ford and General Motors. Musk's new strategy followed a report that Tesla had shelved plans to release a long-awaited new model expected to cost $25,000 in late 2025. The change will enable Tesla to respond faster to the threat of cheap cars from Chinese automakers. This is according to analyst K. Venkatesh Prasad, Chief Innovation Officer at the Center for Automotive Research. There is an urgency. If you didn't have speed, then you lose the game, Prasad said. The announcement sparked a surge in Tesla stock and drew widespread praise from investors. Some analysts expect Tesla to offer basic versions of the Model 3 and Y, which currently start at about $39,000 and $43,000. Sean Marshall, NTD News.
All right, just heading on to break now real quick. And coming up, Secretary of State Antony Blinken says there is evidence of the Chinese regime attempting to influence upcoming U.S. elections. Hear his assessment of the situation. Now, if you've landed a job making $100,000 or more a year, well, the reality here is that not all that money is yours to keep. So how much do you really need to make to keep $100,000 a year? We'll tell you after the break. And welcome back. Just some quick headlines for you to keep you as up to date as possible today. So, a follow-up on a story that we talked about. Anglo-American rejected BHP's $39 billion takeover offer today, saying it significantly undervalued the miner and its future prospects. As well as shares of Hertz Global slumped over 20%. This is after the company reported a wider than expected quarterly loss, highlighting struggles with the electric vehicle rental business. And Chinese fast fashion company Shein facing new rules in the EU. Its soaring user numbers has put it in the same group as Amazon, Apple, and Microsoft, meaning it's going to have to do more to fight illegal and harmful content, as well as counterfeit products on other platforms. And breaking news here. Just now, the general counsel for TikTok and its Chinese parent company ByteDance is stepping down. This is according to a company statement. Eric Anderson will become special counsel to the company, where he will lead TikTok's effort to fight a bill that just became law this week. The law gives ByteDance 270 days to divest in TikTok in the United States or face a ban. Meanwhile, ByteDance is refusing to sell TikTok. Authorities from government and industry in the U.S. say that TikTok is a national security threat. They say China could use TikTok to spy on Americans, collect data, push propaganda, and compromise phones. ByteDance posted on Chinese social media that all media reports of it planning to sell TikTok, saying that those are false and that it has no plans, in fact, to sell. But if they were to sell, they would only have 1 year. Digital media marketing professor Ari Lightman says if ByteDance were to sell, they would want to do it on their own terms.
It's sort of a forced sale, for one. So what is the valuation associated with the property in and of itself? Right? So it takes time and effort to do it. It's also a very valuable commodity.
If ByteDance doesn't sell, TikTok may continue operating in the U.S. for a long time. Social media professor Andrew Selepak says this is because of the U.S. legal system.
ByteDance recognizes that even though the threat exists that it will be banned, they know that they can tie it up in litigation for years. And even if they lose an original case, they can still appeal that decision, which means that this is going to go on for a long time.
But ByteDance could even potentially win in court, and TikTok then would neither be sold nor banned. Former staff director at the U.S. House Committee on Foreign Affairs, Kristen Jackson, believes China will use ploys to tactics to keep TikTok's U.S. operations alive.
The arguments that they're going to use to try to win this fight is a free speech argument. They're saying, hey, this is free speech. We should have the right to run this company and be at play here. And that's ironic because China doesn't support free speech in China. And China also doesn't allow US tech companies to operate freely in China.
But if it does happen, a sale of TikTok could line up major US tech giants as potential buyers. But it is unclear which of these companies would be in a legal position to take over TikTok, because as some are already facing antitrust lawsuits. And moving on, U.S. Secretary of State Antony Blinken concluding his trip to China today. He met the Chinese regime leader Xi Jinping and brought up the issue of China aiding Russia's defense industry in its war against Ukraine. Meanwhile, in an interview with CNN earlier today, Blinken says the U.S. has seen evidence of China's attempts to influence the upcoming U.S. elections. Listen.
That any interference by China in our election is something that we're looking very carefully at and is totally unacceptable to us. Well, again, I'd have to look at the specific reports that you're referring to, but we have seen, generally speaking, evidence of attempts to influence and arguably interfere, and we want to make sure that that's cut off as quickly as possible.
Blinken said he repeated a message that to President Biden to give to Xi Jinping during their summit last November, that being not to interfere in the 2024 U.S. presidential elections. The Chinese regime has repeatedly denied any interference in U.S. elections, but actors do believe to be connected to the regime have been accused of political interference in other countries, for example, Canada. Now, on the same day as Secretary Blinken's visit in China, the country passed a tariff law to make it easier for Beijing to hit back if other countries slapped tariffs on its exports. The United States and the European Union have been taking aim at Beijing over its excess industrial capacity. Analysts are saying that the regime believes it needs more tools at its disposal to retaliate. It's like a nuclear weapon. They don't have to use it, right? But the point here is to deter others from using the same against Chinese exports. One professor is saying this. Now, the law will take effect on December 1st. How much do you actually need to take home a six-figure paycheck? That's my question to you. Well, a report may have an answer to that, and it says you might need to make much, much more in many states to be able to do that. According to Go Banking Rates, it says in Maryland and Hawaii, you need to make at least $154,000 to meet that goal. On the other end, in states like Florida and New Hampshire, you can make as little as over $137,000, and you can take home a six-figure income. Factors that affect how much you can take home include federal and state taxes, as well as Social Security withholdings and Medicare tax. And, like what old Ben Franklin famously said in the past, that there are only two things that are certain in life, and it's death and taxes. We actually had a viewer tell us yesterday that they make a six-figure income, but actually has nothing to show for it. Well, I mean, it's no surprise, right, after seeing this study. So I spoke to someone, Derek Georgino, risk consultant and NTD contributor, for more on this topic. Derek, as always, thank you very much for coming on the show. So you brought to my attention this new study. Apparently, you have to make $154,000 in some states here in the U.S. just to take home $100,000. Tell us more about that.
Yeah, well, in the great state of California, where I live, you have to make about $153,000 as your income to take home $100,000. For me, this wasn't a surprising study, as California has been one of the highest tax states in the union for quite some time. But just for the average American to think about that for a second. everyone uses the six-figure milestone, Don, as what constitutes a significant income. In some areas, taking home $100,000 actually isn't a significantly high income given the cost of living burden in some of these states. And so to have to make over $150,000 as a salary just to get down to $100,000 of take-home pay after federal, state, and local and FICA taxes is outrageous. And for some of these states that popped on that list, Don, California, Oregon, Maryland, Hawaii, there's a correlation between some of the states that popped on that list and states that actually suffer from some population decline in recent years as well, because after all, people do move with their feet. But yeah, a stunning study, an alarming one too at that.
So Derek, the amount of taxes that's being imposed here, is this common between many states here in the U.S.?
Is more common than you think. I think there are a handful of offenders here that are reaching into your pocketbook more than others, and that study digs into it. States like Florida, Tennessee, Texas, Nevada, New Hampshire, which might surprise some folks, South Dakota, Washington, Alaska. There are many states that don't do this, where you can make around $130,000 to $140,000 and still end up taking home a six-figure net income. So it's not all states, it's not even most states, but there are a handful of offenders here. And something that we discount too, Don, is there are other tax burdens that are not even factored into this right now. In California, we have a gas tax of over 50 cents a gallon. We have property taxes in many of these high cost of living states that popped on that list. In California, and I mentioned California because this is where I live and work, they will tax your bonus, I believe, by 10% or more. The federal government taxes your bonuses by over 20%. So you make a hard-earned bonus, and over, about a third of it is taken right off the top. And if you add FICA, it's even more than a third. So there are more states than we would like to show up on this list. But Big Brother and even Little Brother in the form of states and municipalities are reaching into your back pocket more than you even know, including with sales tax as well, being over 10% in areas like Los Angeles and Alameda County.
All right, great. Thank you for your insight today, Derek. See you next time.
Likewise. Thank you, Don.
And thanks for joining me here today, this Friday. That's all the stories we have for you. If you have any feedback for the episode, feel free to let me know. I do read the comments every day. One last thing before we go, business matters. See you Monday.